Your tech portfolio is about to break, and most investors have no idea. Big tech just killed stock buyback programs, not paused them, not reduced them, killed them. Apple, Microsoft, Google, Meta, the companies that made buybacks a religion, are now redirecting hundreds of billions into artificial intelligence infrastructure instead. This changes everything about how you should be investing right now. In the next 8 minutes, you're going to learn exactly why this is happening, what the numbers actually say, and 3 specific moves to protect and grow your portfolio before this shift accelerates. Most people will ignore this warning, and that's exactly the problem. Let's go. Hook. But here's what nobody is talking about: the real reason they're doing this will shock you. For 15 years, big tech lived by one rule: return cash to shareholders. Stock buybacks became the ultimate wealth machine. Think about it like this: when a company buys its own shares, every remaining share becomes more valuable. Your slice of the pie gets bigger without the company actually growing. Smartly engineered, beautifully simple, absolutely legal. Apple spent $400 billion on buybacks since 2012. Microsoft, $280 billion. Google, $150 billion in just the last decade. These weren't small experiments, they were the primary driver of tech stock performance for 20 years. You own a tech mutual fund. Most of those gains came from buybacks, not earnings growth. But something shifted in 2024, and it's accelerating into 2025. AI changed the math completely. Now these companies face a choice they've never had before: return cash to shareholders, or spend it on the technology that will define the next decade. They chose AI. Hook. The numbers they're spending on AI will make your head spin. Wait until you hear what one company is projecting. Microsoft is investing $80 billion annually into AI data centers. That's not a typo. Per year, Google announced $200 billion in infrastructure spending over the next 4 years, mostly AI-focused. Meta, $60 billion commitment to AI infrastructure in 2024 alone. Apple is quietly spending tens of billions on on-device AI systems. We're not talking about marketing budgets or R&D increments. We're talking about re-engineering global infrastructure from the ground up. Servers, power plants, fiber networks, custom chips, cooling systems. The capital expenditure requirements are unprecedented in corporate history, and here's the critical part most investors miss: this spending is non-negotiable. These companies are in an arms race. If Microsoft doesn't build enough capacity for enterprise AI, Amazon and Google capture the market. If Apple doesn't develop superior on-device AI, they lose ecosystem advantage to Android. The FOMO is real, and it's expensive, so buybacks got cut. Not because the market demanded it, because physics and competition demanded it. Hook. But here's the dangerous part: this spending might not actually generate the returns everyone expects. This is where most financial media gets it wrong. They assume AI spending equals future profit growth. It doesn't. Not automatically. Microsoft's cloud division has 30% margins currently. Their AI-specific offerings, much lower margins right now. Google makes $80 of profit for every $100 in search revenue. Their AI competing products, profitability is uncertain. The problem: AI infrastructure operates on razor-thin margins in a commoditized market. If 5 companies are fighting for AI dominance, prices collapse. Supply and demand economics are brutal. So here's your hidden danger: tech companies are spending massive capital today on products that may never reach the profit levels that justified buyback programs. You could see a situation where a capital spending stays elevated for 5 to 7 years, margins compress due to competition, earnings growth slows despite revenue increases, stock prices stagnate even as companies spend more. This is actually the base case scenario that Wall Street isn't discussing publicly. It's called capital intensity trap. And your portfolio might be walking straight into it. Hook. There's one company making a different bet, and it could define the next decade of tech investing. The implications are direct and actionable for how you should invest right now. First, tech stock valuations are built on buyback momentum and margin assumptions that may not materialize. If AI spending becomes permanent and unprofitable, multiples compress. A company trading at 30x earnings might deserve 20x if capital spending stays at 15% of revenue forever. That's not a 10% correction. that's a complete repricing. Second, dividend and buyback-focused portfolio strategies are dead for tech. If you've been buying Magnificent 7 stocks expecting enhanced shareholder returns, your assumption was wrong. Capital is redirecting to infrastructure, not investors. Third, the real opportunity moves to companies with different models. Companies selling to AI providers, semiconductor equipment manufacturers, power companies, data centers might benefit more than the platforms themselves. Think about it. During gold rushes, the real profits went to pick and shovel sellers, not miners. Your portfolio framework should shift from buy dominant tech platforms to buy the infrastructure enabling AI. Nvidia, AMD, power utilities, construction companies building data centers, these capture different economics than Microsoft or Google. Hook. One sector is about to explode because of this shift, and most retail investors completely missed it. Action 1. Audit your current tech holdings. Write down how much of your gains came from buybacks versus actual earnings growth. For most tech funds, the answer will shock you. 40 to 60% of returns were pure capital return mechanics, not business improvement. Understanding this reframes your risk profile. Action 2. Rebalance away from mega-cap tech platform concentration. You don't need to sell everything. But if tech is 60% of your portfolio and buybacks were driving performance, reduce to 40%. Redirect capital into semiconductor, data center, and power infrastructure plays. Action 3. Establish a quarterly monitoring system. Track capital expenditure as a percentage of revenue for each major tech company. If CAPEX stays above 12% while margins compress, it's a red flag. Most investors watch earnings per share, but you need to watch free cash flow after CAPEX. That's where the real story lies. Implement these 3 actions before Q2 2025 earnings season hits. That's when the market realizes buybacks aren't coming back, and repricing accelerates. Hook. The final piece might be the most important, and it changes everything about risk management. Here are your 3 critical takeaways that will protect your wealth in 2025 and beyond. Takeaway 1. Big tech killed buyback programs permanently, not temporarily, redirecting capital to AI infrastructure that may not generate historical profit margins. Takeaway 2. Your current tech portfolio likely benefited from 40 to 60% buyback mechanics, not real earnings growth, meaning past performance is a poor predictor of future returns. Takeaway 3. The real investment opportunity has shifted from owning dominant platforms to owning the infrastructure enabling AI, semiconductors, power, data centers, construction. This is your portfolio reset moment. Ignore it at your own financial risk. The companies reshaping your financial future are already positioning themselves. But most retail investors are still buying yesterday's winners. Don't be that investor. Subscribe right now for daily deep dives into personal finance, stock market strategy, and the hidden trends Wall Street doesn't want you to see. We drop new videos every single day that teach you how to invest smarter, faster, and with real conviction, not hype.